The IRS just subpoenaed over 10,000 crypto accounts, and your digital wallet could be next on their list. Many believe their decentralized transactions remain invisible to tax authorities, but that is a dangerously expensive misconception. Blockchain ledgers are public, permanent, and perfectly trackable by forensic software. Today, we are breaking down the exact strategy to slash your tax liability while staying fully compliant before the next audit window closes. I'm going to walk you through how the Internal Revenue Service views these assets, the specific forms you need to keep on your radar, and the secret method for tax loss harvesting that could turn a bad year of trading into a significant deduction. So sit back, grab a cup of coffee, and let us get to it. To understand crypto taxes, you have to stop thinking about your digital assets as money and start thinking about them exactly like gold bars or stocks. The IRS treats every single coin as property. When you sell, trade, or spend that property, you trigger a taxable event. If you bought one Ethereum for $2,000 and sold it later for $3,000, that $1,000 gain is taxable income. It does not matter if you left the money on the exchange. It does not matter if you immediately bought another asset with those proceeds. The government wants their slice. The first win for you is simply knowing how to report your transactions without paying for expensive software you do not need. If you have fewer than 20 transactions in a tax year, you can manually track your cost basis using a simple spreadsheet. Your cost basis is just the amount you paid for the asset, including any fees you paid to the exchange. Subtract your cost basis from your final sale price, and there is your capital gain. Keep these records for at least 7 years. If you ever get an inquiry, that spreadsheet is your primary defense against an audit. I remember a friend who traded small amounts on an obscure exchange back in 2020. He thought since it was only $50 here and there, it did not matter. When the exchange sent a Form 1099 to the authorities, he had no proof of his original costs. Because he could not prove his basis, the government treated the entire sale as pure profit and taxed him on the full amount. Do not let that happen to you. Now, here is where things start to get interesting. Once your trading volume grows beyond a handful of trades, you enter the territory of complex tracking. If you are using decentralized finance protocols, staking your coins, or moving assets between wallets, the IRS still expects a full accounting. This is the level up. You need to utilize an automated crypto tax calculator. These tools sync with your wallet addresses via read-only API and categorize your transactions automatically. Think about how much time you spend reconciling your trade history manually. It is a massive drain on your focus. Tools like Coinly or CoinTracker have become the standard because they handle the heavy lifting of identifying wash sales and matching transfers across multiple exchanges. A report from the National Bureau of Economic Research found that investors using automated tax reporting tools reduced their error rate by over 60% compared to those relying on manual entry. That is a massive reduction in audit risk. And let me tell you, when you are sleeping at night, knowing your tax records are organized brings a peace of mind that no moonshot coin can provide. If you are finding this helpful, hit subscribe. I drop videos like this every week to help you manage your financial life better. If this is clicking for you, a quick subscribe helps me keep making these, and I have something even better coming in just a few minutes. Okay, remember how I said I had a secret method that most people ignore? This is the one that separates the amateurs from the pros. It is called tax loss harvesting. Imagine your portfolio took a hit. You bought a token at $5 and now it is sitting at $2. You feel that sting. But instead of just holding it in frustration, you can sell that position to lock in a $3 loss per token. Yes, you sell the loss. Then you use that loss to offset your other capital gains. If you had a $10,000 gain from a successful Bitcoin trade, but you also harvested a $6,000 loss from your failing altcoin, your taxable gain drops to only $4,000. You just lowered your tax bill significantly by selling something that was already losing value. And here's the kicker. If you still believe in the project, you can often buy the asset right back after 30 days to avoid the IRS wash sale rules that apply to traditional stocks. While the IRS has not explicitly applied wash sale rules to crypto yet, this strategy remains one of the most effective ways to lower your liability legally. Let that sink in for a second. You are essentially using the volatility of the market to your advantage. Many investors just watch their accounts drop and do nothing, effectively paying more tax than they owe on their winning trades because they never balance them out with their losers. It is a simple shift in mindset, but it changes your entire year-end financial posture. Before we wrap this up, look at your activity. Did you get an airdrop? That is taxable income at the fair market value when you received it. Did you stake tokens and receive rewards? That is also taxable income at the moment of receipt. Keep a clean house, document everything, and use those losses to cushion your wins. Crypto tax is not the monster that everyone paints it to be. as long as you treat it with the same respect as your bank statements. It is just data. So there you have it. Three real ways to navigate crypto taxes, and that third method of tax loss harvesting could save you thousands of dollars in the long run. You have the tools, you have the strategy, and now you have the plan. If you got value from this, share it with someone who is currently staring at their portfolio in confusion, and subscribe so you do not miss the next deep dive into financial clarity. Keep your records tight, stay consistent, and I will see you in the next one.